Let's take a look at high-flying, fast-moving stock AT&T. Wait, no, that's wrong. I meant AT&T, the old-ass, boring company that barely moves and has a giant dividend. We're talking a dividend close to 8%, which is extremely high for a stock. We're taking a look at this video to see if Gram's investment is still safe and whether or not you can continue to expect that high dividend payout. So currently AT&T pays out a 7.36% dividend yield based on its current stock price and the dividend that they're paying out. Now, the question is that sustainable? Is that 7.36% safe? Will they cut the dividend? Also, let's take a step back and realize what dividend yield is. It's simply the full year dividend amount, which for AT&T is $2.08, divided by the stock price that you bought it at. So in this case, it's actually 7.42% dividend yield if you're buying at $28. So that means if you invested $100 into this company and you had fractional shares, you'd be getting $7.42 every year in dividends. And hey, don't get me wrong. I mean, if you look at the high yield online savings accounts out there, you can't even get 1% on your money. With interest rates so low, looking at AT&T's dividend yield at 7.4% is honestly looking pretty good for if you're trying to get income on the money that you're sitting on. Yeah, that all sounds great on paper, but can AT&T actually continue to pay out these high dividends? And the question is, what do you look at to know if they're paying too much? How do you gauge if this is a high dividend amount? So one metric that you can look at is actually known as the payout ratio, which is simply the dividend amount that they're paying divided by the net income that they have. So it's basically saying how much can they pay out of the profits that the company is making into the dividends, or how much are they paying out to the shareholders as a percentage of their profits. So when I'm looking at a company's payout ratio, I usually get nervous if it's over 80% and especially if it's over 100%. If you look at AT&T's payout ratio, it's a whopping 137%. Now that's definitely a red flag, and it doesn't necessarily mean that it's not safe, and I'll explain later, but this is something that needs to be looked into, because right now it's saying that the net income that the company is getting, or the profits that are being generated, is actually less than the amount of cash being paid out to shareholders in the form of a dividend. Another way to visually make sense of this is if you go to the income statement for AT&T, you see the past trailing 12 months that their net income is $11.9 billion. So if you go to the cash flow statement and go down to the financing cash flow, and look to see how much did they pay out in dividends in that same period, they paid out $14.9 billion. So their net income is lower than the cash paid out in dividends. Well, I guess that settles it. The dividend for AT&T probably gonna get slashed. Payout ratio over 100%. End of story. Sorry, Graham. The dividend's going away, right? Well, not necessarily. We need to investigate further into the numbers, because you have one-offs that can happen in the accounting for net income. You're also looking at one period in time. So there could be a short spike in the percentages based on one-off situations like you have with COVID. You have acquisitions that are depreciating, and so that's a non-cash expense. You also have situations where there may be a write-off, which is also a one-time expense. So with all of those things, it's not necessarily impacting the business over the long term, but it's a short-term one-off that may spike the percentage. So let's take a look at that more specifically. If you take a look at AT&T's third quarter earnings report, you can see that they specifically noted that COVID impacts were 21 cents of the earnings per share decrease. So if you actually incorporate that into their earnings down the future, it's saying that their earnings are temporarily lowered, making that payout ratio look much worse. Something else I was referring to before is impairments. So this is where you basically write down an asset and it's a book value write-off. So it's a non-cash event, but basically you're lowering the amount that your assets are worth on your balance sheet. So if you look at AT&T over the past 12 months, they had a $1.4 billion hit and a $2.3 billion hit. So over the past year, basically they've taken a $4 billion write down in the value of their assets. So that hits the net income, but it's not a cash expense. So they're not forking over more money. It's just writing down the value of assets. Now that's not great, but it does factor in that higher payout ratio that we're looking at. So you're probably thinking to yourself, thanks Colin for the boring accounting mumbo jumbo, is the dividend safe? Well, another way to look at the dividend and whether or not it's safe is to look at the free cash flow generated by the business. And when I say free cash flow, it's basically the amount of money that the company is making from continued operations of the business minus how much cash they're outlaying for capital expenditures to keep the business going. So the difference between those two is the amount of cash that the company can basically pay down debt, send money back to shareholders via dividend, or they can expand the operations and continue to grow the business. Or they can just leave it on the balance sheet, right? So those are the options. The more free cash flow that a company generates gives them more options to decide what they want to do with that money. So going back to the statement of cash flows, you can see that the free cash flow for AT&T trailing 12 months was close to $26 billion. So now when you look at how much money that they're generating from the business and then compare that to how much they're paying out in dividends, it looks much better. So the other metric that we wanted to talk about is basically the dividends divided by free cash flow. So that gives you a different perspective on whether or not the dividend is safe and sustainable. And if you look at the press release coming from AT&T for Q3, they even call this out specifically, saying that the free cash flow is expected to be $26 billion, which would be a dividend payout ratio that would be in the high 50% range. To sum things up, I believe AT&T's dividend is safe. Based on the free cash flow generation of the company, I think that they can pay the dividend out relatively safely. Now, you do have to continue to watch the earnings report to make sure that that 50% or the high 50% isn't creeping up to 60, 70, 80, because that's where you have to be wary of a potential dividend cut. So hopefully you learned you can't look at just the payout ratio, and then you also have to make sure that you're accounting for one-offs as well as the time period that you're looking at the payout ratio to see if anything weird is going on. If you enjoyed this video, please consider giving it a like or a thumbs up and subscribing to Main Street Wolf. Thanks guys for watching, and have a great day.